Okay, so today we'll try to end the concepts of risk and return. Ani, as we'll complete our conceptual part of risk and return, mainly whatever we have not learned, we'll try to solve it through questions. Okay, so I have brought around 7-8 questions for you for this session, which I have already shared in I Learn, and we'll discuss about it one by one. Okay, as we move on. So today we'll be completing the conceptual part. And before starting the session, since many of our friends are yet to join, so let me share you one very interesting news which is happening around. Okay. Please also, if you want to share something which is happening around, yeah, in this starting session, I can always hand over the floor to you. So please let me know on that part as well. Okay. So there is one very important news, right? We might have done wonderful analysis in micro terms. We might sometimes feel that profitability of this company is going to go up, or this is a wonderful profit-making opportunity. But many times, please note that many times, because of regulation, legal constraints, and uh, because of government's intervention, a lot of times we as a company, our profitability, we as a company or as an investor, our profitability is hampered hugely. So one of such example I would like to show you. So whenever you are doing risk analysis, whenever you are doing whenever you are selecting between option A and B where to invest, please also take in mind what the government regulations or what restrictions or what facilitations governments are providing. So one of such example I'd like to show you. Okay. Okay, so one of such example is now as there is again economic trade war going on between China and US. Apple floats above China technology crackdown for now. China also asked a lot of American companies to go back home, right? And because of which shares of those companies dipped by a huge margin. Okay, so let me read out this news. Then please let me know if you want to share some ideas. The Chinese government under President Jinping has rattled investors in Chinese technology companies by announcing regulatory measures meant to curb the country's fast-growing economy while reasserting control over some of its biggest companies. But the US technology company most exposed to China, Apple Inc. Yeah, so one news is that Apple Inc. is one of the biggest exposed company. Now you must also know that all the accessories of Apple and also Apple as well is has a huge manufacturing plant in China, right? Why? Because one biggest advantage of China is its cheap labor cost. Second is its wonderful foreign, I would say, welcoming environment. You know, if you go in a ground level of China, you will understand that government, any product which is exported from China, any product which is exported from China needs certificate from government, and their quality control is awesome. So one of the biggest economic boom of China is because of its maintenance of quality by government itself. So strict government regulation is also can be seen in China. So one Apple Inc. is biggest company which is which has invested in China. So is likely insulated from turmoil for time being. The crackdown of Beijing has caught investors by surprise given the scale and scope, said Dan Avis, an Apple analyst at Wedbush Securities. Its major overhang on Chinese tech names, but Apple has been able to navigate the China political climate unlike any other US technology company in the last 30 years. Apple is able to be more Teflon-like in terms of regulatory focus. On Tuesday, when Chinese tech giant Tencent Holding has its worst day in decade, and Chinese tech companies ranging from food delivery to online tutoring service continuing a multi-day free fall. Please note that Chinese government they issued a strict compliance to online education platform, right? If there is a tutoring app or online regulatory platform, that has to be converted into non-profit as soon as possible. Okay, so that was the regulation which came recently. There were one or two investors which were about to be billionaires within some time, but overnight their wealth is gone. Their wealth is gone off. So that is one example of regulation where how government helps, like government rules and regulation affects adversely, and also in merit-wise as well. Apple underscored its domination by releasing earnings that topped Wall Street expectation for both sales and profit, and reported quarterly revenue that topped 100 billion for the first time. That included strong growth in Apple's Greater China region, in which it reported 14.8 billion in sales and 58% from the same quarter a year ago. Now, if you are investing in a company, Apple company, maybe you like to sell Apple stock for a while, until this Chinese conflict stays. I think it is going to stay for a long time. So maybe you might want to sell those stocks. Why? Because you can see that one of the biggest growth of Apple was in Greater Chinese region, in reporting $14.8 billion in sales. Now China is telling that, wait, if you are an American company, you have to go back to your home, or you have to stay here with restrictions. So maybe they will come back. So this is one of the classic example of how government intervention usually affects companies. So any insights, something you want to discuss or you have not understood, please let me know. Or do you want to add something more? Okay. So then shall I move on?
Yes, sir.
Okay, thank you, Arsena. So one quick news, Nifty is total high, right? It's in 3079. Yesterday, also more than 10 companies had positive circuit. Circuit means increment by 10%. Okay, circuit means that, right? So see, so this 10%, the shares which whose price increased by 10% is called circuit. Okay, positive circuit, and which decreased by more than 10%, exactly up to 10%, that is called negative circuit. So again, Nipsey is moving on positive bull run. Okay, so let me close it down. Let us do attendance. Okay, so before attendance, our in the last class, our nominee was Ivan Shrestha. So Ivan, are you there?
Yes, sir.
Great. So are you ready for today's revision?
Yes, sir.
Okay, thank you. So let me do attendance first, and then I will hand over the floor to you. Okay. Okay. So let me start. Alex. Present. Archana.
Present, sir.
Present. Osis. Present. Dipesh.
Yes, sir.
Great. Ivan.
Present, sir.
Present. Jeju. Jeju Rai, sorry, absent. Marina, present. Ninju, present. Nissan, present. Ojasvi, present. Prakriti, Prakriti Banjare, absent. Prasamsa, present. Praveen, Praveen Khatri,
Present, sir. Present, sir.
present. Present. Raman, present. Ratnaprabha, Ratnaprabha, absent. Revision, Revision, Maharjan, absent. Ritish,
Yes, I'm present.
present. Okay, Revision present. Riwaz, present. Ronin, present. Sachem, present. Salina, Salina, absent. Sarisma, Sarisma, okay, absent. Shekhar,
Present, sir.
present. Smith,
Present, sir.
present. Swarup, present. Eunice, Eunice, absent. So I'll call name of absentees. If you are there, please let me know. Okay, Jeju absent, but yeah, he's present now. Jeju present. Prakriti absent. Prakriti absent. Next, Ratnaprabha absent. Ratnaprabha absent. Next, Salina absent. Salina absent. Next is Sarisma absent.
Sir, present, sir.
Okay, Sarisma present. Last, Eunice absent. Eunice absent. Okay, Salina is also present. So Prakriti, Ratnaprabha, and Eunice, 3 absentees. So we must have 23 students. Okay. Okay, we are done with attendance. So with that, we have come to the session of revision. So today's revisor is Ivan Shrestha. So Ivan, you are given of 1 to 5 minutes.
Okay, sir.
Okay, so you can reiterate in your own words what did we discuss in the last class. So I would like to hand over the floor to Ivan and welcome him to the stage. Over to you, Ivan.
Thank you, sir. Uh, so in the last class, we started our class by reading an article that is adding more stock doesn't always reduce the risk of portfolio. And the main lesson from this article was to realize that in some cases, adding more stock does not always reduce risk. And from the article, we could see that even Professor Chance conducted a study where he told the students to first select the one stock to their portfolio and keep adding the stock until it's 30. Then after he analyzing each and every student, we could see that after holding a single stock to 30, the student increases their risk instead of reducing it. So basically, the article is just by holding more stock doesn't always means reducing risk, but it might even added a risk. Then we studied a risk in portfolio context, which is the beta coefficient, and it means that the tendency of a stock market to more, which the market is measured by the beta coefficient, to more with the A, the market is measured by the beta coefficient B. So basically, it means that it is a point where it is measured whole market performing. So in this beta, there were three concepts. B is equals to 1, which means stock is as volatile as market, and greater than 1, stock is twice as volatile as market, and less than 1, stock is half as volatile as a market. So basically, when the beta is equals to 1, if the market moves up or down, then the stock moves up in similar way. And if the beta is 0, then it does not matter if the market moves up or down. It doesn't matter as it doesn't move or it moves in a low rate. And if the beta is greater than 1, then if the market moves up and down once, then the stock moves twice up and down. Then after, and it is shown that the required return must always be higher as it is the conception of higher risk. Then we studied a diagram that shows the concept of beta of the market, where 4 years market value was given and how the market movement was changed when the beta is equals to 1, greater than 1, and less than 1 was shown. Some of the real life example of beta was Bank of America, which was 1.30, Microsoft beta is equals B is equals to 1, and Coca-Cola B is less than is equals to 0.75, which is less than 1. The studies how to calculate, and then we learned the formula how to calculate the beta coefficient, and the beta formula was given, which is B is equals to W1 Wn Dn. Then we did an example how to calculate the beta. So after calculating the beta and finding out the value of the beta, an example was given of a jungle where if an elephant was more in the jungle, then the market would not be as risky and the market would be stable. And if we want a market to be higher risky, we need more leopards as there is a more risky in the jungle. So after that, we learned relationship between risk and rates of return. In that, we studied a diagram where it shows that higher risk demanded higher return and lower risk demanded lower return. And from the diagram, we could also see whatever return above the risk fee is known as risk premium. And even a formula was given, which was required return is equals to risk free plus material risk premium, material risk premium, material risk premium bracket close and stock ls beta. So after that, we learned shift in SML, which is also known as security market value, which is caused by the increase in expected inflation. And risk-free rate is as measured by the rate of US Treasury security is called nominal or quoted rate. And the formula was RF is equals to R asterisk plus IP. So in the end of the class, we learned some concluding thoughts, implication for corporate managers that all the investors should consider, which was there is a trade-off between risk and risk return. Diversification is crucial. Real returns are what matters, and the risk of an investment often depends on how you plan to hold the investment. Although past given us insights into risks and returns on various investments, there is no guarantee that the future will repeat the past. So in the end, we practice sir gave us a question and we concluded our class. Thank you, sir.
So you are done, Ivan?
Yes, sir.
Okay. Wow, great job, great job. One finest revision up to now. Big round of applause for Ivan. Wow, awesome.
Thank you, sir.
So it is definitely a benchmark for revision. Thank you, Ivan, for your wonderful insight. I really loved how you had covered all the content thoroughly, and you did not skip any important points in those those our slides. So for that, thank you so much. Great job. One of the wonderful performance of section B. So can you nominate someone? Please nominate someone, even for this kind of opportunity.
Ritish?
Who?
Ritish?
Ritish. Ritish has not done revision. So Ritish, please accept the revision.
Okay, sir.
Okay, thank you, Ritish. And again, thank you so much, Ivan. Thank you for that wonderful revision. I'm happy after listening to it. Wow, wonderful. Okay, so let me write the name of Ritish in our roster. Ritish. Kaur. So let us move on. In today's class, I'll try my best to complete our concepts in this learning outcome. Okay, and we'll try to solve more questions this time. Okay, as they say that more questions we solve, better the comprehension. Okay. Okay, as we all know that from the last class, Ivan has already told us in a pure clarity that we were in this slide in the last class, right? So we were definitely discussing overall summary of our risk and return, of first section of risk and return. Yeah, there is definitely trade-off between risk and return. Diversification is crucial. Up to certain level of portfolio, it's great. Up to certain level of portfolio, it's great to diversify. Given that return is constant, but we keep on reducing our risk through diversification. Correct. Next, real returns is what matters. It doesn't matter how much profit is in the books, but it matters how much profit we actually earn after inflation. So always adjust inflation, or always adjust other hidden expenditures which might be there. Okay, so the risk of an investment often depends on how long you plan to hold the investment, right? How long you hold. If you hold stocks for short term, it's usually risky. If you hold for long term, maybe you can hold for 1 year to 3 years. Maybe this is a stock index. It will go down, it will go up, right? What comes down has to go up. So that wise, that is one concept. Although past gives us insight, yeah. So as they say that what goes around comes around, right? Like a fashion. Past usually helps us to analyze things in certain times, but it's not necessarily like clear, right? It's not certain for 100%. That is why we exist, isn't it? We try to predict future as best as possible, right? So these are some of the insights we need to take back home. Another one, stock price versus intrinsic value of stock. Now we are trying to find price of stock. Okay, so today's class is really interesting one. Now if you want to understand how much is the price of any stock, maybe Nobel Bank, maybe NICHI, or maybe any other companies which is existent in NIPSE or which is existent in any other stock exchange in the world, today's class will definitely help you to do that. So we are trying to find intrinsic value of the stock. If we find intrinsic value of the stock and stock price which is prevalent in the market, right? If stock price is greater than intrinsic value, it's overvalued. If stock price is smaller than intrinsic value, it is undervalued. Buy here, right? we have to definitely buy when stock price is less than intrinsic value. You are getting value more than what you are paying, right? So in this case, you need to buy. In the case of when intrinsic value is less than selling price, then you need to sell. Since in FC we don't have sell option, hope that within 1 year or 2 year we will get that kind of stock exchange. But yes, this is what we must do according to the stock intrinsic value. And equilibrium, when stock price is equal to intrinsic value, very rare condition. From point difference also we cannot find like perfectly equilibrium condition, but there might be exceptions. Okay, to determine whether a stock is fairly priced, you need to estimate the stock's true value or intrinsic value. Now please note, this is something to really understand. One, to find intrinsic value, we have two different methods. Please note, we have two different methods. First, discounted dividend model. First one, discounted dividend model, and second one, the corporate valuation model. Okay, first is discounted dividend model and second one is corporate valuation model. In the case of discounted dividend model, if we know whereabouts of dividends, please note that if we know whereabouts of dividend, how much dividend that company is paying us, then we use dividend discount model. If we do not know whereabouts of dividend, then we use corporate valuation model. Usually corporate valuation model is a little bit, I would say, complicated, but as a finance student, as someone who knows about balance sheet, statement of account, non-operating profit, operating profit, working capital, and these kind of ratios are already clear to us, isn't it? We have studied in learning outcome 1, so it must not be difficult for us to calculate both. It's completely child's play, very easy concepts. Okay, so moving on, market equilibrium, when stock price equal to intrinsic value. If stock price is reasonably efficient, gaps between stock price and equivalent shall not be very large. Okay, how will you know that? How will you know that whether stock market is effective or not, or mature or not? What I have been telling you, please don't believe me sometimes. Okay, please don't believe me sometimes. I usually tell you that Nepal stock market is not as mature, it's not as effective as the stock market of US, but can you find it on your own? I've been claiming that US or maybe Indian stock market, Sensex, or market around the world, or European Luxembourg stock market, other stock markets like Luxembourg stock market, these markets I usually tell you, I've been telling you that these markets are usually mature and effective. And I've been telling you that our market, NEPSE, is not mature. So what do I mean with that? I mean that stock price and intrinsic value, actual value of that stock price. For an example, if we have bought one share of Unilever, okay, I'm not saying Unilever, let me take an example of NIC Asia. Right now, right now, okay, so let me give you an example. Right now, NIC Asia's share is around 1000, I think 19, or around this one, 1019. Okay, it is share price of stock, NIC Asia. If I find intrinsic value of that stock, then if intrinsic value is around 600 rupees, right? You can see that there is a huge gap between share price and intrinsic value. Around how much? 1019 is intrinsic value, sorry, share price, and 600 is intrinsic value. So there is a difference around 419 rupees, right? So that means that there is a huge gap between share price and intrinsic value. That means that what shareholders are actually getting, they are getting 600 worth of, I would say, commodity or stock in their hand, and they had to pay 1019 rupees. But the interesting fact is that there are more people who want to have that 600 rupees. They want to have that 600, not rupees, 600 worth commodity or shares in more value, more than 1019. So that is why, because of demand and supplies, because of economy, play of economy, demand and supply point, the price usually goes up and down. But coming in nutshell, as value of that particular share might be less than its actual price, correct? So if they more the difference, more we can conclude that stock market is not effective. So any confusion in this, anyone? Or shall I move on? Guys, please help me out. Shall I move on?
No confusion.
Okay, thank you, Archana. Okay, strategic beta fund or smart beta invest. Giving equal weight to each or giving a weight to each stock as per its dividend or inflow. Thus, they are different than S&P index. Okay, so I think these S&P index are usually index fund. I already tell you. I had already told you that there is a basket, right? It is called index. And if, for example, Nissan, Ninju, and Ojasvi, they are now they have opened an investment company, and what they are doing, this company is called Nissan, Ojasvi, and Ninju, NOA investment company, like Berkshire Hathaway, right? NOA investment company, and they have got one, like they are investing in banks only. For an example, they usually like banks, and they feel that bank will usually give them a good amount of return, and it's usually stable, and risk is usually low. So as they are taking three top banks, they want to invest in three top banks. This index may be called NOA index. So an index can be anything, right? It is a group of stock which is selected under certain condition or under by certain person. So likewise, S&P 500 is the index of US, where their 500 best companies of US are brought together, and their share price is reflected. One very interesting point you can find and research later on when you go back home. Like Warren Buffett once claimed that. Okay, Warren Buffett once claimed that that S&P index, I would say S&P 500 index. Okay, 500 index. Okay, so in this 500 index, you can find Apple, you can find Google, you can find Amazon, you can find Amazon, right? So these all top companies, Facebook, right, Instagram. So these all companies, right, you can find in S&P index, popular companies of all around the world. So Warren Buffett once claimed that S&P 500 cannot be beaten by any of his fund managers, and he simply told that you as an investor don't go to an expert. What you do, you just pick S&P index, you invest all the money in the S&P index, and you'll get huge return. And that is something which even big analyst cannot beat. He once claimed that. And I think in 2018 around, again, research was done, and it was found that the S&P index grew by more than 80%, and it gave a return of around 80%, and his manager's performance was really low. That means that those technical or qualified professionals, they could not beat S&P index 500, correct? So maybe one of the strategies, someone was asking me, sir, how to invest in share market and all. Maybe one of the strategy what you can do is like invest in best blue chip companies, right? Best blue chip companies. If company if market will go to bear trend as well, blue chip would be the ones which will be less impacted by it. Okay, and you'll constantly get good amount of dividends or returns, right? And you can hold them for a long period of time. And in the bull market, blue chip, definitely you will see that in the bull market, blue chips will be the ones which will have huge surge than any other companies, right? In a longer run. Okay, so that would be one of the best strategy as well to invest in stock market. Maybe Nobel Bank, NIC Asia, or Nepal Bank, right? These kind of banks in a bank index. And from telecom, we have only NTC, right? And one from insurance, maybe Shikhar Insurance, right? One from life insurance, maybe NLIC, right? And one from manufacturing, maybe SDL. So you can buy these stocks and hold it, and you can close your eyes and let it flow for maybe 6 months and 1 year. Definitely, the one which is trading for short term, you might beat return of that person as well. You might. right? So that is one big strategy of Warren Buffett, but that is also something we can understand and learn. Okay, so let us start our dividend discount model. This one was dividend and corporate valuation model, and find the pricing of stocks. Okay, very simple, as we have already learned time value of money, and from that chapter we can abstract a lot of learnings, and we can simply put here, right? The name is discounted dividend model. So discounted, we have learned what is compounding and discounting. Compounding was going to the future, right? Like back in the future, there is one movie as well, right? And back to the future means discounting, right? We are moving back to the future, sorry, back to the past, not back to the future. Back to the past is called discounting, right? And into the future means compounding. We want to go towards future, that is called compounding, and back to the past means discounting. Simple. So we are trying to find discounted dividend model, and we usually discount things, right? Why do we do that? We usually try to discount every, like formula in finance. Please note that if it is year 0, if it is year 1, if it is year 2 and 3, we would usually want to know the information today. This is today, right? This is today. So we usually want to have information today, isn't it? So what is going to happen? What is going to happen in the future? What is going to happen in the future? We want to bring that to the present so that we can decide today. We are in the present, and we would want to decide and take decisions. Maybe it may be capital budgeting decisions. It may be investing decisions in the stock market. Maybe investing in land or real estate. Maybe any other decision. Would love to bring these investments to present. So usually discounting is something we usually perform. Okay, so we bring future outflows, future inflows to present so that we can evaluate. Okay, so discounted dividend model, by the name itself, again, one of the formula we know from childhood, right? So by the name itself, we know what it might be, right? Dividend means maybe there is maybe roughly you can estimate that maybe there is involvement of some dividends, right? So dividend and discounted, maybe dividends, we know that company usually give dividend every year, right? Every year. So there might be cases that you might say that, sir, some of the companies do not distribute dividend. Yes, there might be cases, but eventually shareholder invest in companies so that they want to get return, isn't it? So eventually after certain times, or maybe in some years they will not give, but usually companies do give dividend to its shareholders, right? So dividend, maybe we can assume that by the term dividend, maybe there is involvement of dividend. Every year we might get dividend. Maybe it may be 5%, right? It may be 30%. It may be any percentage, but maybe there is an involvement of dividend, and those future dividends maybe we would discount. So its name is discounted. Maybe we'll discount those dividend. We'll try to find the formula, and I will try to find the intrinsic value, not price. IV means intrinsic value of stock. Maybe P0 to the top. This is also called as P0 to the top. Same, you can write IV as well. You can write your own term as well. It doesn't matter, right? If you write value of stock, then you can write this symbol P0 to the top cap. Now, please don't ask me, sir, why there is a cap in front of P and there is a 0 in the leg of P. So we don't have, I think we don't have that much of time, but yeah. So okay. So this is value of stock. So present value of expected dividends. We are discounting dividends. These are the dividends of the future, right? This is year 1. This is year 2. This is year infinity, right? We know that we are going to get dividend up to infinity, and we assume that company is not going to go bankrupt. Okay, we invest in company assuming that company is not going to go bankrupt, isn't it? If for an example, today you are going to invest in certain stock, right? You will not invest in that stock if you are in the position of thinking that this company is going in bankruptcy within 5 years, right? You will not invest. So our assumption is that this company is going to go up to perpetuity, and you are going to get dividend for a long period of time, right? So likewise, RS1, this is RS2 and R to the power infinity. So we know how to discount through time value of money, right? So again, 0, 1, 2, infinity. For some of you, it might be so you have been repeating this concept many times. We already know. Please don't elaborate. But there must be someone who have not understood yet. So I'm addressing them as well. So maybe PO, right? PO to the power is this one, D1. So D1 means first year's dividend, right? Dividend D1 divide by. So how do we discount? We usually add by 1, and R means return, required return, RS to the power 1. So this is how we discount. So likewise, we will do same thing for year second as well. D2 divided by R, RS to the power 2, and likewise D infinity. We are assuming that we are going to get dividend up to infinity, correct? So we summate. If we summate, we sum all these 1, 2, 3, and we keep on adding them, then we get this formula. We get this formula: D divided by 1 plus R to the power T. Summation. T means how many years the project is going to run or on, right? So since this dividend is going to go up to perpetuity, right? We need a specific formula to find dividend as well. Okay. So one is constant growth stock. In dividend discount model as well, we have two kinds of models. Okay, one is constant growth stock. The other is case of non-constant growth stock. Okay, so constant growth stock means those companies which are already mature. These companies dividends are usually predictable. For a practical example, maybe growth of banks. Maybe growth of banks are usually constant growth stock. Okay, maybe their growth is around 2%, right? 3%. But the growth of them is usually constant. Maybe some of the companies like manufacturing companies, like in Nepal as well, Himalaya Distillery, these kind of companies are maybe non-constant growth stock. Their growth might skyrocket and it might go down as well. So you cannot predict their growth. So according to the growth of stock, growth in dividend, growth in terms of share price, right? So according to that, we have categorized into two different categories. One, constant growth stock. Second one, valuing non-constant growth stock. So let us delve into formula. So this is the formula. This is the formula P0 to the power cap is equal to dividend divided by R minus G. Please note that G is growth in this case, R is return, required return, and D is dividend of future. D is dividend after 1 year, not future, after 1 year. Okay, D1 is dividend of 1 year. Many students confuse in this, right? In exam as well, before 1 or 2 days, you will go through the slide and go and sit in your examination. As you are going to solve the question, you are going to you will have problem in this T1. I can again ascertain that maybe out of all the participants or examinees, out of you, 5 or 6 I'll definitely find when we'll be conducting midterm exam. You are going to commit problem. So you will going to mistake this D1. Okay, so please note that D1 is not equal to 0, D0, right? D0 is dividend which is given in this particular year, but D1 is dividend which is going to be given in year 1. For an example, year 1, year 2, 0. D1 means dividend of year 1. D2 means dividend of year. D0 means this current year's dividend. Correct? So as we move on, D1 is D0. Growth is G. So can you say that D1 is equal to D0, 1 plus G? Can you say that? Okay, this is something I think you must understand anyway. So let me share my screen. Okay, so let me zoom it for your convenience. Okay, D0. Okay, D0 is equal to, okay, let me do an example. Dividend, what will be the, okay, what is the dividend given to the shareholders of Nobel Bank in the current year, given that 35% dividend is given in year 1 and growth of Nobel Bank's share is 5%. Okay, so this is our question. What is the dividend given to shareholder of Nobel Bank in the current year, given that 35% dividend is given in year 1 and growth of Nobel Bank share, is 5%. So if this is the question, we can see that what is the dividend given to shareholder in the current year? Current year means where we are D0, right? We're in D0. So this is asked to us. What is given? Growth. G is given. It's not G, big G, but it's small g. 0.05, right? And D, what is given? D1 is given, isn't it? You can again go back to the question. Given that 35% dividend is given in year 1, or you can say that also it can be like Arthik Borsa 77, 78, 79 is given, will be given, will be, okay, it's in the future, right? So given that 35% dividend will be given in year 78, 79. So we are running in current year, which is the current year? Which is the current year today? 77, 78, right? It's already closed. We are running in Shravan, right? So this is your question, okay? Let me zoom out. Okay. So what is the dividend given to the shareholder of Nobel Bank in the current year 77, 78? Given that 35% dividend will be given in the year 78, 79, and the growth of Nobel Bank share is 5%, right? So simply growth, you know that growth is 0.05, right? And D1 will be given, it's in future, right? In 78, 79 means 1 year away from it, isn't it? So, okay, 1 year away from it, isn't it? So 1 year means D1. If it was 78, please don't confuse. If it was, first of all, let me solve this one, and then again I'll change the condition. So in this case, D1, what will be the value of D1? It's 35%, right? It's 35%. Now, what will be the value of D0? Anyone? What would be the value of D0? Please help me out. Can I do this? Let's do this. Like D1 is in the future, right? It's already growth added. Like D0 is something which adds growth, and right. Can I say that D1 is equal to D0 plus growth? Can I say this? D1 is equal to D0 plus growth, right? So if you want to find D0, then what you have to do? You have to take this growth down, so you get this, isn't it? Simple. Right? So D1, this is D1, right? So D1 is usually whatever the share, whatever the dividend you have got in year 1, right? So for an example, again, if D0 is 1, if growth is how much? 5%, right? So what would be the D1? It will be 1 plus how much? 1 plus 0.05, right? Simply it's in number, so you can simply add it. So 1.05, right? After adding the growth, you are going to get dividend of 1.05. So simple terms, D0 is equal to this is divided by, so this is the formula, D1 divided by 1 plus G, correct? So simply to find D0, what you will do, you will like find D1 and then C plus. Okay. So this is your 0.33 is your answer, right? So your D1 is 0.33. So let me change this year, right? Let me change the year. What will be the case if I write here 79 and 79, 80? What will be the case? What is the dividend given to the shareholder of Novel Bank in the current year? What is D0, right? Given that 35% dividend will be given in the year 79, 78. So how many years? From 77, 78, 1 year, 78, 79, right? And from 78, 79, 1 year, 79, 80. So we have been given D2, right? We have been given D2 as 0.35. And we have been asked D0. So can you find D0 right away? Maybe we want to find first of all D1, right? Maybe it's D0. You're getting it or not? This is D2, correct? So as you'll find, this D2 divided by 1 plus G means 0.5, and if you enter, then you get your answer, right? We have found D1 likewise. Now how to find D0? Again, what we'll do? Okay. So what you'll do, you will simply, right, again put on the formula, right? So what is our D1? D1 is 0.33, then you divide it by 1 plus G. G is this much, 0.3, sorry, 0.05. You get an answer 0.31746, right? Now I think you will not encounter any problem regarding dividend, okay? So simply we are adding growth. So any confusion in this? Shall I move on? Or if you have any confusion, I'll definitely repeat. Please let me know. I'm waiting for you. Any confusion?
No, sir.
Okay, thank you.
More than answer, sir.
Okay, thank you, Praveen. Thank you, Arsana. Okay. यसमा है तपाईँ 50% स्टुडेन्ट अब ठ्याक्कै होइन 10वटा पेपरमा चेक गर्दा चाहिँ 5वटा चाहिँ यसमै प्रब्लम हुन्छ कि यो डिभिडेन्डमा तर यसमा झुकिनु भएन भने आई थिङ्क यु आर गुड टु सल्भ दिस क्वेसन अरू त गाह्रो छैन इट्स रियली सिम्पल ओके we were in slide 33. Okay, so this one was the formula of constant growth stock. Okay, so this one was formula, right? So here is D1. यसको हामीले गरे है अहिले D1. So you can see that we have calculated D1, right? So anyway, if D0 is also given in question, if D3 is given or D5 is given, it must not be for you. It must not be problem for you to solve. Okay, so R is required written. It's usually given in question. Okay, no problem at all. G growth is also usually given in question. So whichever the input you will be given in the exam, right? You can always solve now. This is intrinsic value of shares. G is growth, R is return, and D is dividend, right? So this is it. This is the Gordon, this is also called equation of constant growth, and this equation you can only apply. Please note, this is the equation you can only apply if your G is constant, your growth is constant. If your growth is not constant, we have to solve through this constant growth stock. Okay, so you can also, I think, yes, you can relate it with even cash flows, which we have studied in time value of money. Even cash flows means where in every year you are getting constant inflows, right? So even cash flows is like constant growth stock. Uneven cash flows is like non-constant growth stocks. So in the case of uneven cash flows, what do we used to do? We used to calculate each points individually, right? We used to calculate each point individually. That is exactly what we do in non-constant growth stocks. We will be discussing about that as well. So last term of equation is constant growth model or Gordon model, named after Myron J. Gordon. Okay. So here is one question. Let us solve this one. Okay. So question states, okay. Let me share my screen. Okay. So we have got this. Okay. So firm A is expected to pay a dividend of 1 at the end of year, right? Firm A is expected to pay a dividend. Please note, it is writing term in future tense. Okay. So expected to pay dividend means what it is? It's D1, right? Expected to pay dividend means D1. The required return is 11%. What is required return? R? Small r, not big one. What is required return? 11%. Next, other things held constant. What would the stock's price be if the growth rate was 5%? What is our G? It was 0.5%. Now, what is it asking us? It is asking us what would be the stock's price. Means it is usually asking us that value of the stock, right? So price would be, what is our formula? Formula is D divided by return minus growth. We have been given all the metrics, all the three variables, right? So it's no brainer. So you can just select D1 and divide it by 1 plus G, sorry, R minus G, right? R is required return minus growth. Then you will find your answer 16.67. The answer is 16.67. Likewise, our second answer is, what if G is 0%? Other thing remaining constant. G is 0. What will happen if G is 0? We again apply the formula D1 divided by R minus G, right? And we'll get our answer 9.09. So this is the price, this is the value, right? Value between these two stocks. Correct. So any confusion in this? How to calculate our price of stock? I hope now you can find price of current shares as well, you know, which growth are constant. Usually required return is it is based up to you how much or required return. I think you can take data of 3 years, right, or maybe 5 years. According to your analysis, you can take that. G you can find by dividing dividends of two companies, right? Dividends of two companies. You can dividend between 2 years, right? And if you take a sample of maybe 3 years or 5 years, you can find how much is the growth of dividend, right? I'm telling you how to calculate practically. Next, D1, you can definitely find this, how much like banks and these companies are going to issue the dividend, and then you can find intrinsic value of that stock. And the intrinsic value usually depends on how these data as well, these inputs as well, how many years taking into consideration. Okay. Any confusion in this? Please let me know. Otherwise, I'll move on with the concept. Shall I move on?
Yes, sir.
Yes, sir.
Okay. Okay. Thank you, Jeju. Thank you, Sekhar. Okay. Our next concept is valuing non-constant growth stock. Now, in the case of non-constant growth stock, it's usually non-constant growth stock is like uneven cash flows. We have studied that in time value of money as well, right? In the case of time value of money, we used to calculate value of stock individually, right? Because those were those could not be like summated. We could not summate them, right? Now, for many companies, it is not appropriate to assume dividends will grow at a constant rate, isn't it? Now, for many companies, we know that, especially for newbies or new entrepreneurship or growing companies like Google and Microsoft in their starting times, not right now. Maybe now they are growth based companies. Okay, right. So in this case, you can see for many companies, it's not appropriate to assume dividends will grow at a constant rate, isn't it? You cannot assume it. Today as well, if you see NIPSE, a lot of companies, in case of a lot of companies, you cannot constantly say. Usually, in the case of Microsoft in 1990s, when Microsoft was just found, Bill Gates was like in full energy in his teenage times, and he was bringing on team together, and they were really ambitious. At those times, they were not distributing dividend in the first place, or if they were distributing dividend as well, dividend was really low. Now you might ask, sir, why do these companies do not distribute dividend? What will they do is that additional cash flow they usually reinvest so that company will expand. Please note that company has always two options: one, to whether to distribute dividend or whether to reinvest. Okay, whether to give dividend or whether to reinvest. Growing companies usually love to reinvest rather than give money to shareholders, right? And mature companies usually they give dividends, right? Because their growth is somewhat constant, and they try to give low amount of dividend, right? So given that there are two options, one distributing dividend, other reinvesting. Now there is an example where in the initial times of Google in 2000 and Microsoft in 1990s, when these were starting days of these companies, at those times they were not distributing dividend properly, right? They were distributing very low amount of dividend, and their growth of dividend went up over the period, isn't it? Or it went to a constant period at a point, because as like 1% of 1 crore and 4% of 1 lakh, right? Which one is bigger? 1% of 1 crore or 4% of 4 lakhs? Which one is bigger? Now you cannot say that 4% is bigger than 1%, right? You have to see what is the amount that percentage is trying to bring, right? What is the amount that percentage is trying to multiply with? So always make sure that this 4% is not bigger than 10%. Okay, so please don't be confused. So over the period of time, usually companies, when they mature, they usually pay good amount of dividend. Okay, so going back, I'm not saying percentage, I'm saying amount of dividend. Okay, so again the formula is same. You were not super, and these companies are called super normal or non-constant growth firms. Okay, so now how to calculate price or value, intrinsic value of these non-constant stocks? Now here are step number one. Step number one: find the present value of each dividend during non-constant years. Now please note that every company's growth is like this, right? And it will mature after a certain time. Okay, every company's story is this. So at the initial times in Microsoft or Google as well, they were constantly growing like this, right? The curve was shooting up, right? It was shooting up. After one certain point, it matured, right? It matured after a certain point. And as it matured, then this portion, as it matured, this portion is called constant growth point. This point is called non-constant growth point. So what we will do, step one, find the present value of each dividend during non-constant year. Up to the time, like these years, we'll try to find dividends up to those points, and we'll try to find present value of these non-constant years. And for this, we have already got formula. We have got this formula from constant growth stock, isn't it? We have already got this formula for constant years. So out of it, it moves up this one. For non-constant growth stock, also we know that it is going to be constant, it is going to be non-constant for certain times, and it is going to be constant after certain time. For calculating that constant part, we use this formula, and for this part we calculate individually. We calculate present value individually. In the example as well, you can see that from 0 to 3 years growth was not constant, although rate is 10% for, although you can see that rate is 10% for every year, but it is not constant. It could have been 12, it could have been 8 in this example. It's just coincidence that Z is same in 3 years. Okay, so these are non-constant years. And after D3, from D4 to D infinity, from D4 to D infinity, our growth is 4%. D4, D5, D6, D7, D8, and if you keep on taking the company to maybe 25, 26, D25, 26, all things are covered here through this formula, isn't it? Because it's up to infinity, right? Up to infinity. So coming back, this point is covering from 4th year to infinity, right? But before 4th year, what about 1, 2, and 3? Right? What about, sorry, from 3 year it is, from 3 year to infinity it is calculating. So what about 1 and 2, right? For 1 and 2 we discount it, and for 3 we again add and discount it. So let us see one by one. Let me break down. First, step 1, find the PV of each dividend during non-constant years. Now these non-constant years were year 1 and year 2. Okay, so for year 1 and year 2 we calculate present value individually, right? How to calculate? You know how to discount, isn't it? You just divide it by growth rate, sorry, required return. You divide it by required return. Second, find the expected stock price at the end of non-constant period. Now for this we have got the formula already. This is the formula, right? For this part we calculate stock price, right? And then after calculating stock price, this is the stock price for P3 at the at 3rd year, then we discount the overall dividend and P3, we add them and we bring them to today's value. Again, we are sitting in the table today, isn't it? So we would love to take decision today from taking the value of today. Third, add these two components to find the stock's intrinsic value. Now add D1, add D2, add this D3 and P3, which are also discounted, and then we get our value. We get our price, share price, or I would say value of the stock, right? So any confusion in this? Anything I need to clarify? Please understand this, okay? If you understand this, then there will be no confusion regarding how to calculate price of stock. Any confusion? Please let me know, or whether you have understood it already. If then my task is made easy, or shall I move on with next concept? You see, if you know
Got the
the
answer,
formula,
sir.
So thank you, Praveen. So if you know these two formulas, okay, if you know how to calculate through constant growth model, growth stocks and non-constant growth stocks, you can go home and you can calculate for NIPSE stocks as well, okay. But your value and my value or someone else's value might not be same. Why? It depends on how many years you take into consideration, okay. But for your knowledge or for your understanding, you can always try. Okay, so okay, evaluating stocks that don't pay dividends, right? So there are a lot of companies which do not pay dividends. You can go through this slide if you want to, like if you are amongst few 2% who wants to get all from the class, right? You can always go to this slide. I have already shared in iLearn. I'll not be sharing this in class right now. Okay. So enterprise-based approach to valuation. We will know this. Okay. For calculating this enterprise-based value, this is another way of calculating price, right? Or intrinsic value of stock. So for this is the formula, right? Long, hefty formula and all. It just finds how much cash flow that company is going to get. And according to cash flow statement or according to cash flows, and then it divides the amount of value which company is generating and divided by number of shares. And likewise, it tries to calculate. So to understand this, let us solve one question. Okay. So let me share you one question. If you do not pay attention, there is a high chance that you will not understand this concept. So I request you to please pay proper attention in this. Okay, it's very, very complicated. Like I have shared this slide as well. And if you if you want to think in advanced form, or if you want to understand like Feynman, right, Richard Feynman, then you can always I have shared challenging slides as well, right? You can go through one by one. But first of all, let me clarify it. Let me clarify it through one question. How can we calculate our enterprise-based valuation? This is the formula. Okay, this is cash. These are cash flows and capital and net operating working capital. So if you are not understanding it, don't worry. Let me solve one question, then you'll understand. Let me share my screen. Okay, so please pay proper attention in this. Okay, some industries retains and reinvests all its earnings. Now, one thing I already mentioned you that when to apply enterprise valuation model, right? Enterprise valuation model, and when to apply dividend discount model. When to apply this is one, this is two. So when to apply enterprise valuation model? We want to apply enterprise valuation model when company do not pay dividend to its shareholders. Okay, when there are companies which do not pay dividend to its shareholders, okay, then we move on to enterprise valuation model. Because we do not know dividend, then if we do not know dividend, how to apply, how to put input in this formula? We cannot do that, right? When D1 is in numerator, we do not know numerator at all, or numerator dividend is 0, right? Then your value will also come at 0, so it will not be applicable. When company do not pay dividend, we will move on to enterprise valuation model. So in the question also you can get the hint. Some industries retains and reinvest all is invest. What can we understand? We can understand that some industries, they are thriving company. Maybe they want to grow hugely. So without giving any dividend to its shareholder, it is pumping all the money for its growth. Okay. So SOM does not pay any dividends and it has no plans to pay anytime soon. A major pension fund is interested in purchasing SOM stock. Now somebody wants to, a pension fund wants to buy some stock. The pension fund manager has estimated SOM's free cash flow for next year. Now, there is something called estimated. So we as a finance person, we estimate a lot of things. Estimated for what is given in the question? Free cash flow for next 3 years. Next 1 year to second year and third year. Cash flow, what is the cash flows? Free cash flows? 5 million, 9 million, and you can see here 12 million, right? After 3 years, after third year, after year 3, free cash flow is projected to grow at a constant 4%. After 3 years, it's going to grow constant 4%, 0.04. Okay. SOM's WACC is 10%. We have been given. WACC means cost of capital. Again, cost of capital means at what price you are going to get, at what rate you are going to get money from the market. That is what WACC denotes. The market value of its debt and preferred share is 27 million. SOM has now, so this is some market value of debt and preferred share. Preferred. What does it mean? The value apart from equity shareholder, for stock for preferred stockholders and for creditors, this is the market value which is present there. Means this much money SOM owns, this much money SOM owns to creditors and preferred stockholders. So this pie is going to be for all the pie which or if profit is called the pie, then that profit is going to go first to creditors and then to preferred shareholders, and then only remaining portion will be given to equity holders, isn't it? So 27.2727 million worth of money, right? This is the amount of valuation of total stock. They have taken loan, I would say loan or fund from stockholder and creditors. Now, certain percentage interest rate, maybe they will charge around 10%. Certain percentage, maybe they will charge around 10% or 8%, whatever, or 3%. Let's assume 10%. That is the amount they are going to charge, right? It's in million. Okay. So market value of debt and preferred stock is 27.25. SOM has 10 million in non-operating assets. So this is non-operating asset is 10 million. 10 million. And it has 5 million shares. How many shares are there? Common shares, common stock. 5 million. 5 million, right? Common stockholders. And 5 million. So now we have been asking to estimate SOM's stock price, right? So a lot of details has been given. Please ignore this detail for a while. This market value of debt and equity, please ignore this for a while. Ignore this number of stock and ignore this non-operating asset. I'll come back to it. Let us focus in cash flows, growth, and WACC first of all. Now, how can we calculate our stock price applying corporate values model? First of all, we will try to find cash flows of the company. Okay, so we can see that, we can see in the figure, in the first year cash flow was 5, 9, and 12 in second and third respectively. So in the first year 5, second year 9 million, third year 12 million, isn't it? So what is the rate? What is the rate of WACC? Rate of WACC is 10. So we discount these cash flows with 10%, correct? We discount these cash flows through by 10%. So you can see value of company's operation. What will be the value of the operation? Value of the operation would be the value of earnings it is going to give. What did I tell you? What is the value of asset? Value of asset is value of inflows it generates, right? What is the value of company? Value of company, again, value of inflows and benefits it generates. Inflows and benefits it generates, correct? So likewise, you can see value of company's operation would be how much dividend it is going to give, right? How much earning it is going to extract, and how much is that price which they are going to cover after third year. So like in non-constant model also, we are trying to find inflows and discount it. Now 5 divided by 1.1, 9 divided by 1.10 to the power 2, and again 202 for to calculate 202, what we do, right here you can see that. So this is cash flow, is cash flow at the growth is after third cash flow, the growth of cash flow after a third year is 0.04, right? 0.04. So while inputting this formula, now you can see at that time I told you that you are going to get confused in this, is equal to, right, is equal to, what happens is that 12.48 is, what is 12.48? So if you multiply this 0.04 with growth, this is fourth year, right? So first year, second year, third year, right? In the third year, what is his return? The pension fund manager has estimated SOM's free cash flow for the next 3 years, 5, 9, and 12. 5, 9, and 12. And what would be the inflows, cash flows in fourth year? Here it is written growth, right? Free cash flow is projected to grow at a constant 4%. You can see free cash flow is projected to grow at a constant 4%. So you have to add these 4%. Now, what would be for fifth year? Let's assume, right? If you want to know about fifth year, then you again will multiply it by growth. What is the growth? 4%. So 1 point, for your convenience, 1 plus 0.04. Should be growth. This should be our free cash flows for fifth year. Now it goes on constant, in a constant base. After for sixth year, seventh year, eighth year, we keep on adding growth. Okay, so for fifth year it's not needed. For fourth year we calculate it. Why? To apply this formula. To apply that formula, D1 was there, right? So for price also we calculate like that. P1 is here, P1. So P1 is price of fourth, right? And we divide it by WACC, and WACC is 10, return R minus 4 is G, like the formula we applied. So as we'll do this, we will find the value 12.48 if we divide it by bracket WACC, return minus growth, then you will find the answer 208. So we got price of that value of stock at third year. Now we discount these both and we take it to year 0. So this is the value of company's operation, 220. If you discount it by 1.10, we got 5 in year 0, 9 in year 0, 220 in year 0. Correct? So this is company's operations. Now what will be the value of company? These are operations from cash flows, from operating assets, isn't it? Usually cash flows are generated by operating assets, correct? So likewise, in the question we are given a non-operating asset of 10 million, right? This is non-operating cash flows from market value of non-operating assets. So value of company's operations was 177. If you add value of non-operating assets, you get overall value of the company. So this is the overall value of company, 187.27 million. Now you can see out of this 187 million, out of this 187.27 million, this is very important. Please keep in mind, please have your attention here. 187 million, one part is of creditors, one part is of preference shareholder, one part is of equity shareholder, right? Shareholder. So we are trying to find how much is the share price, right? Or how much portion. For that, how much is the share price? We know number of shares. So if we know the value which is allocated to equity shareholders or value of equity shareholders, then we will value of equity shareholders which is assigned to them, we will definitely find shareholders. Now here in the question we have been given the market value of its debt and preference stock totals 27.27 million. So out of total value, Out of total value of 187 million, around 27 million, around 20, not this, around 27 million is allocated to creditors and preference shareholders, right? So what would be remaining value for equity shareholder? Remaining value of 160. Right? This is the total value. If we divide value by number of share, then we get per stock price, isn't it? So total number of stocks are 5 million, right? 5 million. 5 million. Then if we divide this by 5 million, then we get our answer 42, right? So question is also doing so. Value of company was 187. Market value of debt and preference shareholder was 27. As you'll divide it, it is the value which will be assigned to equity, right? So value of equity will be divided by number of shareholders, then we get per share. So any confusion in this? Anything I need to further evaluate?
Sir, how did you calculate the 12.48?
Which one? 12. Okay, 12.48. Yes, this one. Like अघि मैले हजुरहरूलाई भनेको थिएँ नि, T1 क्याल्कुलेट गर्न के गर्थ्यो हामीले B0 मा ग्रोथ जोड्थ्यो है, B0 मा 1 + C. यो बुझ्नु भएको छ नि है? पुरानो डिभिडेन्ड हैन, पुरानो डिभिडेन्डमा पुरानो ग्रोथ. डिभिडेन्डको लागि मात्रै हैन यो फर्मुला भनेको, स्टकको प्राइसको लागि नि सेम हुन्छ के है. सो क्याश फ्लो के हुन्छ? हामीलाई क्याश फ्लो दिएको छ 5 है. क्याश फ्लो, द पेन्सन फन्ड म्यानेजर हैज एस्टिमेटेड सोम्स फ्री क्याश फ्लो फर द नेक्स्ट 3 years एज फलोज. 5 million फर फर्स्ट इयर, 9 million फर सेकेन्ड इयर एन्ड 12 million फर थर्ड इयर. अनि अर्को कुरा के भनेको छ भन्दाखेरि हाम्रो क्याश फ्लो भनौँ न, क्याश फ्लो फर which year? Third year. Third year is given as 12, right? This is one data which is given. Now another line है यहाँ हेर्नु ल. After year 3, free cash flow, यही free cash flow. After year 3, free cash flow is projected to grow at a constant 4%. Third year पछि चाहिँ constantly 4% ले infinity सम्म grow हुन्छ भनेर भनेको छ है. So what we can understand from this? G is 4%, right? अब हामीलाई के हाम्रो फर्मुला चाहिँ के थियो यहाँ भन्दाखेरि, यो फर्मुला इन्फिनिटी सम्मको कुनै पनि डिभिडेन्ड निकाल्दा है. So let me show you this. You see what is the formula? Constant growth stocks मा डिभिडेन्ड को केसमा नि यही हो. तपाईको क्याश फ्लो को केसमा नि if you want to find price from cash flow, यही फर्मुला युज हुने भयो. तर D1 युज भइरहेको छ, फ्युचर वाला डिभिडेन्ड युज भइरहेको छ है फर्मुलामा. RS and G इज अहिलेको हैन, कति हामीले एक्सपेक्टेड रिटर्न र जी गर्छौं, तर D1 चाहिँ फ्युचरको. सो त्यसकै लागि कमिङ ब्याक फर द सेम थिङ, फोर्थमा हामीले यो क्याल्कुलेट गर्दा चाहिँ WACC 0.1, ग्रोथ 0.04. अब माथि कति राख्ने भन्दा चाहिँ थर्ड इयर को राख्ने हैन, 12 को राख्ने हैन, 1 year अहेड को राख्नु पर्छ के, 1 year अहेड को. सो 1 year अहेड कसरी निकाल्ने? CF4 निकाल्नु पर्यो 1 year अहेड भनेको है. सो CF4 इज इक्वल टु क्याश फ्लो 3. यो भन्न पाइने कि नपाइने? 1 + G. पुरानो क्याश फ्लोमा कन्स्टेन्ट ग्रोथ हुन्छ भन्दाखेरि हामीले ग्रोथ एड गर्न पाइन्छ कि पाइँदैन है? CF3, right? CF3 1 + growth. So यसलाई क्याल्कुलेट गर्दाखेरि CF3 12 bracket 1 + G, we get our answer CF4. Is equal to CF3 is 12, growth 1 + growth is 0.04, and we get our answer 12.48, right? Got it, Ratna?
Yes, sir. Thank you.
Okay, so any other confusion? यसमा अलिकति डिटेल चाहिँ अलि बढी भयो जस्तो अरू मोडल भन्दा अलिक डिफ्रेन्ट अलिकति गाह्रै छ यो इफ यु हेभ कन्फ्युजन प्लिज लेट मी नो
Sir, त्यो लास्टमा divide by 5 किन गरेको?
कुनमा भन्नुभयो
त्यो 160 divide by 5 गरेर $32 per share को.
ए यो डिभाइड बाई 5 भने चाहिँ टोटल भ्याल्यु तपाईँको इक्विटी भ्याल्यु अफ इक्विटी भने 160 भयो होइन अनि यस्तै पर्खिने यो किन गरे भने ओके सो 5 केजी पोट्याटोलाई होइन तपाईँहरूले 2000 रुपियाँ दिनुभयो होइन 1 केजी पोट्याटोलाई यो भ्याल्यु भयो भ्याल्यु क्वान्टिटी होइन 5 केजी पोट्याटो तपाईँले 2000 रुपिजमा ल्याउनु भयो घरमा होइन सो प्राइस कति हो भन्दाखेरि कति हो प्राइस भन्दाखेरि तपाईँले टोटल भ्याल्युलाई कति पैसा पुरै तिर्नु भयो टोटल भ्याल्यु डिभाइड बाई क्वान्टिटी 5 भनौँ न गरौँ न इज इक्वल टु 2000 टोटल भ्याल्युलाई तपाईँले क्वान्टिटीमा डिभाइड गर्नुभयो भने 1 केजी पोट्याटोलाई 400 पर्दो रहेछ थाहा भयो नि त्यस्तै प्राइस अफ सेयर निकाल्दा प्राइस निकाल्दा के गर्यौँ टोटल भ्याल्यु डिभाइड बाई क्वान्टिटी गर्यौँ टोटल भ्याल्यु भनेको 160 क्वान्टिटी भनेको 5 मिलियन यहाँ छ 5 मिलियन इट हेज 5 मिलियन सेयर्स अफ स्टक बुझ्नुभयो
Yes, sir.
So any other confusion anyone our class pani I think it's already 34 I have to end the class as well okay so with that next in the next class we will complete our risk and return and तपाईहरुको टेस्ट चाहिँ Wednesday हुन्छ multiple choice question and please circulate this among your friend as well graded multiple choice question हो graded assignment जस्तै marking system huncha so please be prepared for your test on coming Wednesday so tomorrow we'll be solving question hai ta risk and return ko so I think that let me pause the recording so everyone thank you so much for your attention